Good morning and welcome to Dollars with Cents. This is Terence Vanderwood.
And I'm Ella Lang. I'd like to thank you for joining us today on this for this episode of Dollars with Cents. We're your financial gurus, and you can contact us at twofinancialgurus@gmail.com. You can always call us on 778-879-0820. Today's topic we have is about mortgage insurance and how to use mortgage insurance wisely to ensure for you any possibilities in your life. You plan for the worst, but you achieve the best.
That's right. Great planning. We're going to be talking about insurance for your biggest liability, your mortgage. And the difference between personal life insurance and the mortgage insurance that you get at the bank. The difference between that and having your own personal insurance that covers not just your liability to the bank, but also for your loved ones, that's the reason for today's topic.
And the subject of insurance may be uncomfortable for you because it involves talking about death. And yes, it's a tough thing to think about. While it's a certainty for all of us, it is part of the circle of life, and that's okay. But why not be prepared? And what's the other certainty in life?
Taxes.
Yes, of course, taxes. So I don't want to make today's topic too serious. We're not going to always be talking about death. And of course, we're going to make it lively. But when the end comes, the way you leave things for your loved ones makes a big, big difference for them.
Yes, it certainly does. And so today, to make the topic accessible and fun, we're putting it into a real-life scenario. So when we come back, we will discuss the insurance plan we have put together for the Barsantis. Bob and Sue are husband and wife, and their children's names are Johnny and Marcia. You're listening to Terence Vanderwood and Ella Lang on Dollars with Cents. Welcome back to today's topic, shelter, your shelter, and more. Ella and I are your financial gurus for the next 20 minutes. And as we show you the difference a professional like Ella and myself can make when making decisions on insurance.
Yes, insurance is a key component to the 4 cornerstone philosophies of growing and protecting your wealth.
Yes, so let's put you in the situation. You're sitting in front of your representative of the bank. You've just filled out all the paperwork for what sounds like a great rate. Your monthly payments are going to be affordable. You like the terms. And then they come down to tick the box about insurance on this $375,000 debt. You think, obviously, you're supposed to do it because it would be a wise thing to do.
Well, most people would look at it and say, well, of course I want my biggest liability covered in case I got hit by a bus. And of course it's going to cost you an extra $80 on your monthly mortgage payment of, say, $1,725. But wait a second, that's $80 each according to the BMO Mortgage Protection Insurance quote. And seriously, Terence, this is according to the website that the link should be showing up on your screen right now. Remember, you can also follow our topics and conversation on transcripts that are provided on our Facebook page, Dollars with Cents.
Yes, good call, Ella, about the Dollars with Cents Facebook page. So $160 a month, that's a significant amount. So let's say that our family, Bob and Sue Barsanti, and their children, Johnny and Marcia, are the ones in the room and have agreed to this coverage, the room being in the bank. As they have done this, they have committed $160 per month to go towards mortgage insurance. What Ella and I are going to do for you is to find out what kind of protection we can have in place for the Barsantis with that budget. Both Bob and Sue are 42 years old. Little Johnny is 7 and little Marcia is 3. As said before, they have a mortgage debt of $375,000. Bob works as a plumber and makes $80,000 per year, and Sue works part-time as a makeup artist in the film industry and makes about $35,000 per year.
These are the other assumptions. They are relatively healthy, they're non-smokers, and because they have just bought a new home, they have no other outstanding debts. They wish to retire at 60, which will be in 18 years. What does this have to do with their mortgage insurance, so coverage? Well, this is the step that makes all the difference in the world because, as you will see on your screen, it's all part of the insurance needs analysis. This is a process that takes you and your family's life into consideration around insurance. As you can see by the analysis, Bob's insurance needs come in way above the mortgage debt. At $1.4 million, he will be covered, so in case he dies, the mortgage will be paid off, the funeral expenses will be covered, there will be $10,000 for unknown expenses, the kids will have $40,000 each for their education funds, and Marcia will have an annual income of $57,000 per year for the rest of her life with an investment return at 5% annually. So excuse me, I think that's actually his wife will have the annual income of $57,000 per year, not Marcia. That poor old, poor old Marcia. I had to put that in there.
3 years old. How's she gonna make $35,000? Oh, sorry about that. Well, and that is a whole lot more than just a mortgage. Obviously, all those other things covered. On the flip side, you can see that Sue's needs also extend well beyond $375,000. If Sue were to suddenly pass, the mortgage would be paid off. The kids will have $40,000 each for post-secondary school. $10,000 would be for unknown expenses, and Bob will have a salary of $12,000 annually for the rest of his life. And just to be clear, the insurance policy pays out a lump sum amount of money, so the categories we are mentioning do not have to stay this way and are completely adjustable. This is just to give some peace of mind and clarity to what can be covered.
And just one last note on how well protected the Barasantis are. If there is a scenario where Bob and Sue get into a car accident together and do not survive, Marcia and Johnny will be emotionally devastated, but financially well off, as both policies will be paid out to give them almost $2 million to support them. This is the kind of insurance planning that will give complete peace of mind. So the choices are to have your mortgage insurance covered for $160 per month, or to have a full family to protection for, drum roll, $124 per month, and 8% less if you pay annually. So if you put all those together and pay just the one lump sum, that's a savings of over $55 per month for literally 3 times more of coverage.
Now that does sound like solid insurance planning. You see, everybody, the benefits of having a complete or holistic plan in place is such a smart way to protect you and your loved ones from the worst possible scenario. Of course, there are many more aspects around insurance planning to be fully covered, but we won't get into those today. We will be discussing them over the next few weeks to ensure that you all have a clear understanding of what the risk management framework is.
We need to take a short break, but when we return, we will spell out for you the 6 top ways a personal life insurance policy is way better than a bank's mortgage insurance. My name is Ella Lang, and you are listening to Dollars with Sense. Welcome back to today's topic, Shelter Your Shelter and More. Terence and I are your financial gurus for another 15 minutes as we show you the difference a professional like Terence and I can make when making decisions on insurance. Speaking of professionals, we want to mention the importance of seeking professional help when it comes to all financial matters. It's a complicated world, and an essential detail can be easily missed for the do-it-yourselfers, so please use a professional. You can contact us with any questions or feedback at twofinancialgurus@gmail.com, or by phone, call us at 778-879-0820.
Thanks, Ella. So here are the top 6 ways to a life insurance policy is way better than a bank's mortgage insurance. Number 1. You own the policy and designate the beneficiary. The mortgage insurance, the lender or the bank, is the owner. With mortgage insurance, the lender or bank is the owner and beneficiary, the one who receives the payout, and is entitled to receive the full death benefit. There are no amounts that would be paid to your family.
All right. Number 2, your coverage will not decrease. So your personal insurance coverage remains level, the same annual or monthly payments as your mortgage decreases. With mortgage insurance, you're covered only for the declining balance while continuing to pay the same or perhaps higher payments, that is. As you all know by now, insurance is the least expensive the younger you are. So let's say you are happy with your mortgage, but you will need to renew in 5 years. When it comes time to renew, many people are looking out for the best rate, and often that means switching institutions. Well, guess what? Those institutions will recalculate the mortgage insurance coverage based on your age, which will be more expensive because you're 5 years older now.
Number 3, your personal insurance continues after the mortgage is paid. So with mortgage insurance, the coverage expires when the mortgage is paid off. With a solid life insurance plan, not only will the coverage be in place, but you can have the opportunity to convert some of the term insurance into a permanent insurance policy that has the ability to become an asset for estate planning and will stay with you for your entire life without a lifetime of payments. This, again, is known as permanent insurance and is a whole different topic for another session. I believe our next session, partly our next session is around permanent insurance with us, your financial gurus.
All right, top tip number 4. Only you can cancel or make changes. So your premiums are guaranteed for life of the plan, and you can make changes as your needs change. With the insurance that protects the liability, the lender may change the premium or cancel a mortgage insurance policy at any time. We often get asked if there's such a difference. Why do so many people choose it? Well, I would say that it's the path of least resistance. With that insurance, you tick off a box and it's all done. With ours, your health is measured and you as a person are weighed in with the entire population of Canada of your age. After that, specialists called actuaries use the math to decipher how much it will cost them. So as you can see, the process is a lot easier than the other when you're sitting at the desk and just want all the paperwork done and signed.
Oy vavoy, the paperwork. I remember much of that for the mortgages. But remember the benefits, because 3 times the coverage, $55 per month, which if used to go towards investments, you will have increased your net worth by $9,000 in 10 years. That is also known as lost opportunity cost. So is going through the underwriting process worth $9,000? I would say yes.
You bet, it sure is. Here's top tip number 5. Your coverage stays with you if you move. So personal insurance is portable wherever you go. Even outside of the country, it will be with you. As I said before, if you want to renew, you want to make a change or change institutions because you get a better rate elsewhere, your personal insurance will move with you. If you decide to sell your house or move to Thailand for 6 months, it'll move with you. The other choice is, in most instances, you may not even be able to transfer mortgage insurance to a new mortgage or a new lender and will need to requalify for new coverage. Again, that means it will be 5 years later, or you'll be 5 years older, and the monthly premiums will just cost more.
Yes, and for the 6th and final way, a life insurance policy is way better than the bank's mortgage insurance. Your coverage is confirmed when you apply. Mortgage insurance may assess your eligibility only when you make a claim, leaving you unsure of your coverage. With personal insurance, your medical history is reviewed before the policy is issued. You're assured that coverage will be in place when you need it. There's a great YouTube video from CBC's The Marketplace that shows a tragic story of what happens to Canadians when an event in their life causes them to be denied the mortgage insurance that they had dutifully paid month after month. The link should be on your screen, or again, is available in the transcript of our Facebook page, Dollars with Sense.
Yes, it's a profound 20 minutes. I really recommend you watch it. I remember it because it managed to combine salsa dancing with mortgage insurance. It was very well presented. And I can't say that I've actually seen that ever before, so very cool. And they do a good job of explaining the details of how these policies are such a bad choice. I, as your financial guru, highly recommend to watch this 20-minute episode, and you will never hesitate to not check that box again.
Yes, I, as your other financial guru, totally agree. A great investment of only 20 minutes. Well, we need to take a pause for a break, but when we get back, we'll do a quick review and give you your action item for the week from Dollars with Cents. We are back with this week's topic, Shelter Your Shelter and More. It sounds like a Rolling Stones song to me. I am Terence Vanderwood, and here with my colleague Ella Lang. Ella, do you realize this is our 12th episode?
I know, it's so cool. It's amazing how time has flown by and how great it is to be able to spread the good word about financial planning. I'd really like to thank Rod and Matthew at CKPM 98.7 FM. That's the Tri-City Radio guys for helping us and having us on our radio waves. And to Dana and Michael at the Tri-City Chamber of Commerce for being a part of making this come to fruition. I'm looking forward to at least another 12 episodes where we can give you, our listeners, a chance to know about 80% of the population what they don't know. So not only that, it gives you action items so that you can put your newfound knowledge into action right away.
That's true, Ella. I gave a financial planning seminar to a bunch of college students last week, and part of that presentation was the importance of action. I summed it up like this: vision without action is a dream, action without vision is a nightmare, and vision with action can change the world.
Wow, that's deep, Terence. Did the students like it? Did they dig it?
Well, there was a whole lot of blank stares, so perhaps it flew over their heads. Anyways, your action item for this week. Get an insurance needs analysis done for your family. Contact your favorite insurance advisor and ask them for a complete analysis of what your insurance needs may be. The great thing about doing it this way is that you come up with the numbers. The insurance advisor should not provide the details of what you want to leave behind for your loved ones.
Perhaps you will find that your favorite insurance advisor doesn't provide this service. Well, if so, then why is she or he your favorite advisor? I'll ask you that. If you're in need of a new or don't have an advisor, just let us know. We can arrange for a time to sit down for us for a half an hour, and you can get this type of report as you see on your screen right now. For those of you just tuning in and listening, it is the same report we use for the Barasanti family that we provided before. At Investors Group, we offer this type of service at no cost or obligation to you, and you can walk away with a written report.
That's right, Ella. That's one of the great many things about Investors Group. They're really client-centered and focused, and that is why I'm proud to be part of this organization. Hey, Ella, did you know that IG is celebrating 90 years old in 2016?
I know. That's unbelievable. That means they started in 1926. That's just 3 years before the Great Depression in 1929. Can you imagine a young financial company making it through that?
Yes, it's quite incredible and a great company to be with. So again, your action item is to get an insurance needs analysis for your family. With that knowledge and a good grasp on your cash flow, that is income and expenses, you will be able to find the right insurance solution that will fit you. That's a ton of info for today. Join us next week when we get deep into the luscious details of permanent insurance and how it can be a very powerful tool for the very young and a strategic and equally powerful way for the elders to make a choice of paying their favorite charity instead of giving away part of their legacy to the tax man.
Remember, everybody, insurance is an important component of your overall financial plan. And like your financial plan, the insurance you choose should be a perfect fit for your unique needs. Discuss your options with your professional advisor to ensure your plan provides the right protection for you and your family.
And let us know your thoughts. You can contact Ella and I at twofinancialgurus@gmail.com. That's the number 2, financial gurus, all one word, at gmail.com. Or you can call us at 778
879-0820.
Thank you, Ella. We love the feedback. And you might even hear your question on the next episode of Questions and Answers. Don't forget to like our Facebook page, Dollars with Sense, and leave us a comment there. This information is a benefit to everyone, so help us spread the word. Thanks again, and have a great week. I am Terence Vanderwood with Ella Lang, and may your sense and dollars be with you.